It seems like everybody wants to buy apartments right now. But what if I told you that chasing multifamily in this market might be the worst move that you could make? We've been sold this dream that if you just buy enough doors, you'll be financially free. But here's the reality. You're not walking into a gold mine with apartments. You're diving headfirst into a red ocean. It's overcrowded, it's overpriced, and it's completely oversold. And if you're not careful, it could end up costing you a lot of money, or worse, years of your life with very little to show for it. I've been in commercial real estate for nearly a decade, bought everything from retail centers to boutique hotels, and I've seen this shift happening in real time with my own portfolio and with the hundreds of investors that I work with through my commercial real estate investment coaching. They call it passive income, but there's really nothing passive about owning apartments in today's market. Sure, you can hire a property manager, but who's managing them? You're still overseeing the budgets, the contractors, the rent collections, and the evictions. And let's talk about that for a second. Have you ever had to evict a single mom because she lost her job and couldn't pay rent? I haven't, and I'll be honest, I don't ever want to. It's the kind of decision that could keep you up at night as an investor. No one mentions that on the syndication webinars. Multifamily investing isn't just time consuming, it can be emotionally exhausting. You're not just managing buildings, you're managing people's lives. And when the market tightens and people can't afford their rent, you become the bad guy. Meanwhile, the deals themselves, they're not even that great anymore. They haven't been for quite some time. Most of the value add apartments out there, they've already been renovated 2, 3, sometimes even 4 times since 2012. There's just no upside left, but the prices keep climbing. You're buying somebody else's leftovers with zero room to improve and very little cash flow to show for it. So now you're stuck, overpaying for underperforming assets, fighting for margin in a low cap rate, high interest rate environment, and being sold the dream of financial freedom while spending your nights reviewing CapEx spreadsheets and fielding angry emails from tenants. That's not passive income. That's a second job with none of the benefits and all of the headaches. Let's look at what you're actually getting with multifamily right now. Go on Crexi or LoopNet, whatever you want. Filter by apartment complexes and start clicking through the listings. You'll see deals trading at 4% to 6% cap rates, sometimes even lower. I personally wouldn't buy any apartment complex unless it was like Class A and 300 units under a 7.5% cap rate because the returns are just too low. There's too much work to be done for the amount of money that you're going to make, and that's before financing. In today's interest rate environment, your debt is more expensive than your return. So unless you're walking in with all cash, you're losing money on day one. And yet people are still buying these apartment buildings. Why? Because they've been convinced that apartments are safe, that rent growth will bail them out, that forced appreciation is just a few renovations away. But let's be real. How much value are you really adding by installing vinyl plank flooring in a unit that's already been updated twice in the last decade? Meanwhile, look at neighborhood retail or flex space or even self-storage. I'm seeing deals trading at 7, 8, sometimes even 9% cap rates with real value add potential and upside. More cash flow, less competition, and in a lot of cases, a better tenant profile and fewer headaches. It's not about chasing the newest trend. It's about understanding risk-adjusted returns. And right now, multifamily isn't penciling out no matter how you run the numbers. Again, unless you're paying all cash. And if that's the case, why are you here? And I get it. Multifamily feels safe. People will always need a place to live, right? That's what everyone says. And on the surface, it makes sense. But let me ask you this. What do you think is actually safer? A 1970s apartment building with 30 tenants who can leave every 12 months, who call you when the toilet breaks, who stop paying rent when the economy turns, or a flex warehouse leased to a plumbing company on a 5-year triple net lease, meaning you don't have to pay for common area maintenance, property taxes, or building insurance, who takes care of their own maintenance and never calls unless it's about renewing. Apartments might feel familiar, but that doesn't make them any less risky. In fact, the emotional safety of multifamily is often what leads people to overpay for these assets. They assume it's less risky because they understand it. That's a dangerous place to invest from. Plus, think about the tenant turnover. With apartments, you're managing dozens, maybe hundreds of individual people, each one with their own problems, life changes, and reasons for not paying on time. There's always a great excuse. But in retail or flex, you might have 5 tenants, 10 at most generally, and they're business owners. They've got skin in the game. They treat your property like it's their own because in a way, it is. And the leases, they're longer, they're more stable. And in many cases, you're not even paying for repairs or dealing with the day-to-day headaches. So While everyone else is over here fighting over 4-cap multifamily deals, there's real money sitting quietly in the corners of commercial real estate that most investors never bother to look at. It's time to stop confusing familiar with safe, because in today's market, they're not the same thing. Let's talk about the concept of a red ocean. It's a market that's overcrowded, ultra competitive, and saturated with investors all chasing the same deals. And right now, that's multifamily. You've got syndicators, institutional capital, first-time investors, 1031 buyers, doctors that make more money than they know what to do with, and they're just willing to buy things and lose money on it because it sounds good. And they're all clawing over each other for the same tired apartment complex. You're not competing against 1, 2, or 5 other buyers. You're competing against 50. And the brokers know it. So what do? They underwrite these deals to perfection. They bake in aggressive rent growth. They project razor-thin expenses. They package it all up to make the numbers look very pretty, way better than they really are. And guess what? They're wrong, and people still buy them because they're emotionally attached to the idea of owning apartments. But think about this. If everyone is playing the same game, chasing the same product, and using the same strategy, where's your edge? What's your margin for error? That's the trap of the red ocean. You get caught up in the game. You're not investing, you're speculating. You're banking on future appreciation just to make the deal pencil. Now, contrast that with retail or flex or even self-storage in the right submarkets. Fewer buyers, better cap rates, real value add opportunities, and far less noise. You're fishing in a pond that most people don't even know exists. Multifamily had its run, don't get me wrong. It worked for a very long time. But right now, the water is red. There is blood everywhere, and the smart money is already swimming somewhere else. Now, don't just take my word for it. I want to introduce you to someone who's been deep in the multifamily world, and Dave Codrea is one of the principals at Greenleaf down in Atlanta, a real estate investment firm that at one point owned thousands of apartment units. They did the whole thing, everything that you all are wanting to do. Class C to Class B value adds, full value add cycles, renovations, and then they stopped buying apartments pretty much altogether. Why? Because they saw the same thing I'm telling you now. The margins were shrinking, the upside was gone, and the operational headaches just weren't worth it anymore. So they pivoted into retail, into industrial, into flex space. Assets with stronger cash flow, less competition, and real room to add value. Well, so let's start off. Just introduce yourself, tell us about Greenleaf, and tell us about your history with apartments.
Dave Codrea started a company called Greenleaf in kind of the heyday of when multifamily was an epic disaster, which was really like 2008 to 2012. Bought right around 4,000, 4,500 units in that time frame, and did a ton of the value add story that was happening in that time frame all the way up until 2018, 2019, and that's really when we started seeing a big shift in how the margins and how the business was performing, and we started shifting into commercial assets. The investment returns that we need to make this thing make sense, we saw kind of the tides are changing at that point in time. We got pretty heavily into commercial, and since then we've done about 50 commercial acquisitions really in the past 6 years, but using a lot of the experience and knowledge we built on the multifamily side to dive into the commercial side and really grow our portfolio.
So what changed in 2018, 2019? Like, what were the margins that y'all were going for when you were doing these projects? And then what did they become around that time?
You know, the margins we're aiming for when we're doing a big value turnaround deal, it's like our investors are taking on a lot of risk to do that, right? You're tying up capital. You don't really have distributions for at least a 18-month, 24-month period. So it's got to be worth going into something and say, look, I'm not going to get distributions for a little bit. There's time risk, there's cost risk. You have all these risk factors when you go rehab something and turn it around. By the time you're stable, you've got to at least be making double-digit cash on cash distributions on an annual basis. We can get to that. We have investor appetite, and we feel like that's a good deal that can perform. Now, if we can't, we either can't hold this deal or we can't even start a project if we don't see a way to getting to double-digit cash on cash returns on an annual basis. And since 2019, we've only seen the margins on the residential side continue to erode. The presence that's in the residential side where there's a lot of rent growth and people aren't super happy about all that rent growth, right? If you're a renter, you're like, why is everything getting so expensive? But then the costs are outpacing even that fairly high rent growth right now. And it's been that way in our markets. I mean, we're in Atlanta, in most of the Southeast. In all of our markets, we've seen that for the past 5 years. Just continue to push with, yes, rent growth, but expenses are way outpacing rent growth.
What was it like shifting into commercial, and what made y'all make that decision?
So one of the first commercial buildings we bought, we're looking at this deal, and it's a 2-story cedar siding deal that exterior walk-ups, and we're looking, we're like, and this thing looks like an apartment complex. It's garden style. It's got 8 buildings. We're like, this could be apartments. So we're looking, we're like, we can operate this. It looks just like any of the apartment stuff. So we really did an apartment renovation. We took off the cedar and we put on hardy plank. And anyone doing multifamily renovations, and I was like, well, that's an easy one to do on the outsides. And then we went inside and just did the interiors, which is flooring, carpet, painting. It was a lot of the same work. So we felt pretty comfortable doing it at that point. We did have to learn what the leasing process was like on the commercial side. It's definitely different than the residential side. There's pros and cons to it. Typically, you're getting longer leases, dealing with someone who is more looking at it from a business angle, not so much like, hey, this is my home. And they also come with typically higher deposits up front, or better financials. I mean, you get to see their full financial picture when you're looking at a commercial lease. So, but that part's been good. And it's fun. I mean, we like talking to residential tenants when they're moving in places and see how they got here, why they're in Atlanta, what they're doing. Same thing with businesses. They all have an interesting story of what they're looking to do in their space. And it's been fun conversations.
What types of commercial real estate do you guys like to look at?
Well, we've done a couple different types now. As we've grown in that segment, we really like it's kind of called flex, but we like the single story assets with a lot of parking. But we've also, medical deals are fantastic. We like the retail, like dollar store opportunities out there. We've bought a dozen plus of those of like Dollar General type locations over the years. And we're pretty opportunistic. So we like a lot of the stuff that's out there, but it's all lower density and flat. So even a dollar store, the medical stuff we're buying, or flex stuff, it's all typically lots of parking, lots of land, 1 or 2 story building. So that's really our bread and butter, is that asset type that we know we can operate.
Yeah, you'd really have to be opportunistic to make the shift from apartments all the way into commercial. What are your thoughts on commercial versus multifamily today?
Well, on the multifamily side, the main challenges we see are, I mean, taxes, insurance. It seems like, you're beating a dead horse on just how much those are going up year over year. Our insurance rates are up just over 30% a year for about 5 years in a row. That's a big one. Taxes, property taxes as a whole have gone up significantly. And it's really hard to pass that stuff through on the residential side, because residents are looking at it like, oh, this is the big bad landlord trying to just make more money on this. So it's hard to even maintain a positive viewpoint of margins staying where they are. On the commercial side, a lot of times when we have a conversation with a tenant and there are pass-throughs of expenses that go to that tenant, a little bit, we're on the same side. We're like, how do we make sure our insurance as a whole is lower? What can we do to make sure our property taxes are in line with values? Because if the tenant is splitting some of those costs, you're more in alignment with them of like, we want this property to operate as efficiently as possible, because it benefits the tenant. They pay lower common area maintenance, which is something they don't have on the residential side. The commercial side, a lot of tenants are paying some of the operating expenses as part of their lease. So they're on board to try and make sure we do this thing as efficiently as possible. And that's a refreshing conversation that you can have on the tenant side that doesn't exist on the residential side. So that's a big part of it. The lease structure enables us to be more aligned with what the tenants are trying to accomplish as well.
So if apartments aren't the move right now, then what is? Well, let's talk about the place that still work, where the numbers pencil, the upside is real, and you're not competing with 1,000 other buyers. I'm talking about neighborhood retail, flex space, light industrial, even self-storage, again, in the right submarkets. These are assets that have been underbuilt for years. Demand is up, supply is tight, and the competition, honestly, it's pretty minimal compared to multifamily. You can buy these assets at below replacement cost, add value through leasing or light renovations, stabilize the income, and then do the same thing that you would do in multifamily. You could refi, you could sell, you could hold the thing for long-term cash flow. That's the kind of deal that builds wealth, and they're out there right now. They're everywhere. We definitely don't have any issues with deal flow. You just need to know where to look and what to look for. And that is exactly what I help investors do inside my CRE Accelerator Mastermind. We focus on off-market sourcing of these deals, building stronger broker relationships, underwriting the right way, and finding deals where the value hasn't been completely squeezed out yet. And the best part is, when it comes to commercial real estate, you don't need to be a syndicator or have millions in the bank to get started. You just need the right plan, the right process, and the right people around you. So if you're ready to stop chasing bad apartment deals and start buying better assets with stronger returns, this is your sign. Check out this video next, where I break down how to find value-add deals in commercial real estate that actually work.